Welcome to you all once again. Thank you very much for taking out time to join this webinar. Myself, CA Balaram Achidi. I am CEO and founder of Spectrum Auditing and Spectrum Group. Along with me, we have CA Girish, who is taking lead in corporate taxes from Spectrum Auditing. So I'll let him introduce himself during the course of the webinar. So we've been here for the last 10 years in providing various services like audit, CFO services, VAT, corporate tax, structuring, and company formation services. So the main objective of conducting this webinar is to discuss, since we have completed 1 year of our initial period of first filing of corporate taxes for almost all the companies which have got relevance are expected to comply and file the returns. So we've noticed some areas where we had an opportunity to do it better. We had an opportunity to plan the tax properly to minimize or to optimize the tax position. And some areas where they could have been handled much before than later so that there is no compliance issue. So these are the few areas where we noticed some improvements that can be done before the end of the year, so that the taxpayers can take advantage of the optimization of the tax positions and making sure that the compliance is done effectively. So with that perspective or objective, we wanted to discuss where all we've noticed or where all we have seen the opportunity to optimize your tax position and where you could have handled better to make sure that the compliance is done properly. So these are the two primary objectives for which we wanted to discuss more areas and then share with you all. We will run through these areas. These are the some of the important areas that we've noticed. There could be others which we might not be discussing here, but they could be relevant to your case. If you have any questions at the end of the webinar, we have also planned for some time to address your question and answers. Those question and answers will be addressed with a limited understanding of the situation. And of course, before you take any decision, it is advisable to refer to the law and take the decision. So the areas that we wanted to discuss were more about the ongoing compliances. Like, it is not just one-time compliance that you have, but it is going to be an ongoing compliance for various years. And for the year also, it's not just for the end of the year, but throughout the year, you're expected to comply with. We'll run through what are the areas that you need to take care of to make sure that they are doing compliances on an ongoing basis. Also, since you have filed the corporate tax returns already, what are the areas that we could see some errors that would have happened or may expect to happen? And then how can you address or identify them and how can you address them? Do you have any penalties and how can we address those errors and then correct or rectify them and make sure that we are complying with them properly? And of course, then since we are in December, for most of you, the corporate tax returns are filed, or the taxable period is January to December. Since we are in the month of December, so if there are any opportunities to make sure that we are addressing some areas where we have gap, we still have the time because we are in December for this year. So we wanted to just focus on those areas where you can look into and see that you're prepared for this filing when you go for next year or next in January onwards for this year. So some of the common areas of opportunities where we could see to optimize your taxation situation was tax group, be it tax group or the normal group or regular group of the tax losses adjustments. And also we have seen some areas for family foundation if you are able to are eligible to do it. Family foundation is one important area where you can focus on doing tax optimization. So there are a few areas which were commonly applicable to most of the entities. So we wanted to discuss or bring these points across to you all. So if we get into this ongoing compliances, as I mentioned, so it's not just 1 year that we need to look at. We need to look at the keeping right amount of documentation and keeping the information accessible, not just for 1 year, but next 7 years from the end of the financial year. So there are some information and documents that are directly connected to your returns that you have filed. So you're expected to keep that information readily accessible, and whenever FTA wants to look at those documents or information, you should be in a position to provide them within the period that they ask you to submit in. Generally, they give about 5 days notice and ask us to submit those documents or information. We should be in a position to provide those documents or information in order to avoid any penalties. And at the same time, there could be some other information which may not be directly part of your return, but maybe irrelevant, and based on which we would have identified or come up with the tax amount or taxable amount, taxable income, and those information and that information of those documents also are supposed to be kept ready so that we can provide them in time. So let us go through some of the documents and information that are relevant for these two areas. There could be other information and documentation that you may have to keep them ready depending upon your kind of business. But here we are just focusing more on the general ones, are the ones which are relevant for most of the taxpayers. So there are certain primary records that you are expected to keep as a taxpayer. One of the important one is if you are a group or if you have branches or if you have entities here in UAE and entities outside of UAE. So you are expected to keep the information with respect to your corporate tax structure, be it with respect to your branches or subsidiaries or holding company or various jurisdictions, maybe within UAE, in mainland, in free zones. In free zones also maybe in financial free zones or designated zones. So that the structure with respect to your group and then transaction flow also with respect to the transactions that are happening within the group. So the details of those are expected to be, I'm sure most of you must have worked on it, but you should keep them readily accessible whenever you have to submit, whenever they ask for these details. And the next thing is about the detailed trial balance. The trial balances, which will show your opening balances, transactions during the year, and then closing balances, and with a detailed breakup of the numbers or ledgers based on the relevance or based on the importance of them from the point of view of corporate taxes. So you must have already worked on this, but keeping the detailed trial balances, standalone trial balances of each individual entity within the group, and if you have done consolidation or combination, then the detailed information with respect to that consolidation and combination is what we also need to keep them ready. Since the financial statements for corporate taxes are expected to be prepared by following IFRS, which is clearly mentioned in that, not only for this year, not only for 2024, they also would ask you to submit the comparative figures, which are nothing but for 2023 or 2022 based on your tax period. So that comparative figures also are expected to be provided. You need to be ready with those information or those details also. In some of the cases, we have seen that they were asking for comparative figures for 2022 or 2023 also as part of the additional information that they are asking from the taxpayers. So before they ask, you should be ready with all those details. And other thing is that you're expected to maintain your or prepare your financial statements in AED. If you have maintained your books of accounts in some other currency, you should have your financials ready and prepared in AED currency also. So that is another important thing that you have to maintain. And of course, the bank statements may also be asked to submit, and then you should have proper reconciliations for all your bank statements or bank accounts. And the FTA may ask you to submit bank statements for the period. So these are the some of the few documents which are primarily relevant are required to be maintained. And they may ask for you to provide these documents whenever they want to look at those. So based on this, we have also drilled down some specific areas related documents that you may have to maintain. As again, as a basic information documents to be provided for. Revenue being one of the important area, so we focus on revenue as well as the expenses. So these are the two areas which will help you in arriving to the taxable income to a significant extent, unless you have some transactions or some items relevant coming from balance sheet items. So detailed ledger with respect to your each account and description of those accounts are expected to be kept ready. Revenue and expenses, for sure, they are the important ledgers that you have to make sure that you have full details of. And sales details, sales related information, you have to have the location, geographical location of the transactions. Since you have to have Emirates wise revenue details or taxable income details, you are expected to maintain those details also by Emirates. If you have in free zones and mainland entities, then you have to have clear identification of the transactions happening from mainland entity and transactions happening from free zone. And if you have any common transactions that are happening from branches and head offices, all those location details you're expected to maintain properly. And cost breakup, if you have any direct cost incurring relating to those sales, those direct costs with locations and entities should be maintained properly. And reconciliation of your sales as well as VAT. Now, since we have value-added taxes also, we must be filing the VAT returns. So the sales as per VAT and sales that you've submitted in corporate tax returns that you filed, reconciliation of those are expected to be maintained. At the same time, expenses that you have shown in VAT returns versus expenses that you've considered for corporate tax returns should also be there. And proper breakup of all your transactions and ledgers that are relevant are expenses that are relevant for corporate taxes, like if you have any entertainment expenses you have incurred. As we know, the entertainment expenses incurred for employees, they could be allowed 100% for corporate tax purposes as expenditure for computation of taxable incomes. But if entertainment expenses incurred for owners, customers, and suppliers may not be allowed fully, and they may be allowed only 50%. Likewise, you have other expenses which may not be allowed fully. So you have to have clear differentiation or demarcation of the expenses or ledgers maintained separately for each of this category of expenses, so that whenever FTA comes back and asks you to submit or provide the details, you are ready to provide them without any delays. So these are the few important elements to look at for revenue and expenses. And other supporting documents for with respect to financial statements. So some things like lease agreements. So the agreements that are basis for your numbers that are flowing into financial statements should be there, like list of employees and when is their date of joining, and what is the amount of salary that you mentioned in the agreement as per the labor laws or the other related free zone laws. Employment contract is the basis for you to look at to show or to consider your salary amount or other benefits that you pay to employees, and which you would have considered for expenses, employees' expenses, which you must have considered for your computation of taxable income. Likewise, professional service agreements, fixed assets register, which is another important register which you are expected to maintain. Date of purchase, your economic useful life of the asset. If there are any disposals, partly disposals, then those disposals, and then depreciation workings. All these details are expected to maintain as part of a fixed asset register, because you may have depreciation and other related information coming out of that fixed asset register. Record of inventories, if you are into industry which is having significant amount of inventories maintained or inventory is relevant, then your proper records relating to inventories are also expected to maintain. your purchases, your consumption of that, and if you have any closing stock related inventory, and if there are any deteriorated inventory related information, that also you need to maintain. Cash book and other related ledgers. If you have any credit sales, the details of collections and bad debts, anything related to current period or previous periods, whether you are eligible to take them as expenditure and all. So all those details you are expected to maintain. If you have any correspondence with your customers with respect to your bad debts or collections, those also will become your supporting documents for the bad debts that you have claimed or provision that you made, since they are determining or influencing your taxable income. If you have any loan agreements, of course, loan agreements related to current period or previous periods, or periods before your corporate tax was enacted, all those becomes relevant to maintain because they all will determine your or influence your taxable income amount also. There are certain other important areas like related party transactions. This is one of the areas where a lot of litigations could happen. So you're expected to maintain proper documentation with respect to transactions with related party to demonstrate that they are at arm's length. If you already have benchmarking done, that becomes your primary supporting document to show that the transactions were done at arm's length. And if you have any transactions with connected persons, they also are important for tax or corporate tax purposes. You again were expected to demonstrate that the transactions with connected persons were at market rate, and the support documents are maintained properly for that. If you have not done any arm's length pricing analysis and all those, better you keep them ready so that you can show them whenever they are asked for. If you are expected to maintain local file, master file, depending upon your turnover and geographic location, so you are supposed to maintain that. While filing the return, you may or may not have worked on this properly, but now you are supposed to at least keep them ready so that whenever FT asks for those details or documents, you can submit them. With respect to your transactions with related parties and connected persons, there are some thresholds mentioned, but they are relevant only from the point of view of submitting the returns and submitting the additional information while filing the returns. But you are expected to maintain the benchmarking and other documentation supporting for all the transactions, irrespective of the value of the transactions. Of course, you have to have intercompany agreements and other invoices to support your transactions with related party and connected persons. Other records, like if you have, since you are expected to choose the elections like realization basis or unrealization basis, so relating to workings relating to those elections and documents for those positions are expected to be maintained. And if you have any tax losses which you are carrying forward for future period, or if you have tax losses which are adjusting with other group entities, then also, Bharatji, can you not share your screen, please? Yeah. So if you have losses that you are adjusting with other group entities, then documentation relating to those tax losses adjustments within the current year and carrying forward for future years, that reconciliation and proper support documents for those things are expected to maintain outside the books or in the books if you have facility to maintain. Transitional provisions related documentation also expected to maintain properly. If you are a qualifying prison person and if you've done analysis, are you able to maintain that? Were you able to maintain that for previous year? And for this year also, are you able to maintain that qualifying prison person status? Are you making sure that the conditions that are required to maintain are intact and you're not losing the status? Tax group related assessment also you're expected to do, and throughout the year expected to comply with those tax group. Girish will focus a little bit more on that tax group related area also. These are some of the basic documentation that you're expected to maintain and some of the information that you're expected to maintain as a basic requirement. There could be others which are relevant based on your business, which you are expected to maintain. And in addition to this, FTA also brought in few more sections within your corporate tax returns also. Something like, Girish, can you move? Yeah. Something like they can ask you for additional clarifications or additional information in the form of clarifications with respect to your files or returns that you filed already in previous year. So you need to keep monitoring, keep checking your Imara tax portal account and go to this section with respect to your corporate tax returns that you filed in the section of written clarifications. So there could be some questions they FTA may be asking you. They may be giving you certain deadlines to respond to those clarifications. You need to keep checking those and keep checking your registered email inbox so that you are addressing them in time. At the same time, they also brought in audit section. If your file is selected or picked up for audit or for assessment, then you will be asked those additional information in this audit section. They may also notify you in the mail, but you have to check all the places to make sure that if your file is picked up, you are looking at that and you are addressing the questions or queries that are asked by FTA within the time. So the advice is that you don't need to wait for this audit. You have to make sure that you are keeping all the documentation and information in or keeping the information ready so that whenever audit comes, you are ready to address and provide the additional information as requested. So these are the few areas that you're expected to look at to keep yourself ready. And then what are the errors that we may come across, we might have committed, and what is the way forward to address them if you have any mistakes or errors that you have committed in the files that you've already filed, in returns that you've already filed. And then what are the kind of penalties that we may have? All those things we will look into in the further slides. I would invite Girish to take this forward, and then we will have question and answers after addressing going through these slides. Girish, over to you.
Thank you. Good afternoon, everyone. This is Girish this side, Corporate Tax Lead in Spectrum Auditing. Until now, we have basically seen that corporate tax compliance is not something that is just an year-end activity that you have to do. You have to consistently maintain all of those documents during the year so that your return filing becomes an easy process. And if for 2024 we are not yet ready, at least we can start collating all of these and keeping them very readily available because the authorities may ask this with a specific timelines. Now, there are twofold benefits. One is when you have such strong documentation behind your tax return, okay, supporting your tax return. The first thing is that the taxpayers are confident of the information that they are filing, and the second thing is there may be very little chances of an error or something getting missed out. Okay, so while we collate all these things, if at all we have found that there is any kind of error in the corporate tax return that we have already filed, then what is the way forward? How can we correct them? And basically, whether there would be any kind of penalties that would be levied or there won't be any penalties. So there are different kind of scenarios which we'll be discussing. Now, if any error has been identified in the tax return, which is after the due date, okay, and after the due date, whatever error we have identified, we need to assess what is the tax impact of that error, or the mistake that we have done in the corporate tax return that we already filed, okay. If the tax impact is less than 10,000 dirhams, okay, if it is equal to or less than 10,000 dirhams, over here, tax impact means if the tax that we calculated is less than the correct tax amount that we should have actually paid. Okay, so we have underreported our taxable income or paid less tax. Now, what is the shortfall of that tax if that is within 10,000 dirhams range? Okay, in that case, if there is any future return which is due to be submitted for any previous periods, or the tax return for the period in which we have identified that mistake, in that tax return we can make this adjustment and mention the amount of the adjustment that needs to be made, and then in this case there would not be any requirement to file a voluntary disclosure. Okay, so basically, if we have underreported the tax amount by less than 10,000 dirhams, in that case, this benefit may be available. However, if there is no CT return due, say we have deregistered or filed for a deregistration for corporate tax purpose, there is no future return that we are going to file. In that case, we may have to go with the voluntary disclosure. Similarly, if the tax impact or the tax that we have computed was falling short of the correct amount of tax and the difference was more than 10,000 dirhams. In that case, also, we'll have to go with the voluntary disclosure option only. Further, when there is no tax impact, okay, in that case also, the guidance that is mentioned indicates that there would be a requirement to file a voluntary disclosure only. So basically in these cases, if any kind of option or any kind of details or disclosures that we have not made or missed to make, those things can be done over here. Now, if you have identified more than one errors, then in that case we have to consider the aggregate tax impact of all the errors and we have to see the 10,000 threshold limit. Now, in this case, it is also important to note that if we have paid an extra tax, okay, in that case, if we have paid extra tax compared to the tax that should have been actually paid, in that case also we will have to go with the voluntary disclosure, even if the difference is less than 10,000 dirhams. Now, with the screenshots, to quickly glance through what is the procedure of, making the correction in the tax return, okay, where the tax impact is within 10,000 dirhams. You can go to your tax return, the subsequent tax return that you're going to file, and under other adjustments tab, there is a question in all your subsequent returns, which asks whether there has been any error with a tax impact within 10,000 dirhams limit. If we select yes, then there is a schedule that you can fill. Okay, and you can add the details. You can specify the tax period in relation to which there is a mistake. You need to mention the amount of the adjustment, and then you need to give a description of that adjustment, like what exactly it pertained to. And then that would automatically be taken care of in your subsequent tax return. Now, similarly, if you have to file a voluntary disclosure in all other cases where you cannot correct in your subsequent return, you have to go to that respective return where you have found that error. In that, in the drop-down option, you'll get an option of voluntary disclosure. Over there, we can file, we need to do the enable editing option under the relevant pages, and then we need to make the changes and save and submit the return again. Then it would be considered as a voluntary disclosure. Now, these are all the requirements if we have identified an error before after the return filing due date. If it is within the return filing due date, we can amend the tax return after it has been filed. Under the drop-down options, we'll get that, and then that can be automatically corrected. But after filing, after the due date of the corporate tax return, if you have found these errors, then the next steps would be as per the flowchart that we just saw. Now, whether the voluntary disclosure comes with or without any additional cost. Now, voluntary disclosure actually comes with certain additional costs. It is not something that the tax authorities, encourage, doing any kind of errors. They want us to be careful at the first instance itself. So basically, if we have found that there is any incorrect error, if there is any details are incorrect or we have made any error in the corporate tax return, then there is a fixed penalty of 500 dirhams. This is not levied in case the voluntary disclosure is submitted but there is no difference in tax due, or the corporate tax return has been amended or corrected before the return filing due date. So if we have found it before that, then this penalty won't be levied. Now, as a result of voluntary disclosure, if there has been any additional tax liability that has come up, then on that 14% per annum interest will be calculated on a monthly basis on the unpaid tax amount, whatever is the difference, and it will be calculated from the return from the payment due date. The payment due date is the return filing due date only. From the payment due date till 20 days, 20 business days from the submission of the voluntary disclosure. Okay. So basically, in this case, the tax liability should be paid within 20 business days of filing the voluntary disclosure. So in this case, if it is not paid, then in that case, the 14% per annum interest would be calculated and it would be levied. Now, for the delay in filing, for simply for the purpose of filing the voluntary disclosure, okay, if we have filed a voluntary disclosure, then on the tax difference amount, 1% per month is calculated. this penalty will be imposed from the CT return due date till the date of submission of voluntary disclosure. Okay. The late payment corporate tax penalty is if we have not paid within 20 business days of filing the voluntary disclosure, the tax due, then on that in that case the 14% per annum interest will come. Now this is plainly for filing of voluntary disclosure. This penalty would be there. The third one, which is 1% per month on the difference, on the tax difference that is coming. Now, if we have not filed voluntary disclosure before the authorities came and notified that, okay, we are going to pick up your case for a tax audit, okay, and if we are filing a voluntary disclosure after they have, notified that we are going to pick up the case for pick up the case for tax audit. Now, in that cases, 15% fixed penalty is going to come on the tax difference, and then 1% per month will be calculated on the tax difference amount. Now, this will be calculated from the date of CT return due date till you submit the voluntary disclosure. Even after the authority specifying that the case is going to be picked up for tax audit and there has been an error which we did not correct by voluntary disclosure, in that case, the 1% per month penalty will be computed till the time the tax assessment is finished and it has been issued by the tax authorities. So basically, after seeing that in the previous returns, if we have made any error, what is the way forward? How can we correct it? What are the different scenarios? Now, if we can just think about going forward, what are the future for the future tax periods, what is the planning that we can have in place so that we ensure that we do not miss out on any kind of benefits or any kind of exemptions that may be beneficial to our businesses. We'll discuss it further in the subsequent slides. So these are just few cases that we have identified that the taxpayers may generally miss out or they may not have the relevant structure in place to take the benefit. So a few of them would include tax grouping. Now, tax grouping comes with certain conditions which have to be fulfilled. So if at all we have missed it for 2024, we can analyze it for 2025 and ensure that all the conditions have been fulfilled, and then you need to make certain applications to avail the benefit of the tax group. So certain applications have to be filed by the parents as well as the subsidiaries, and that all needs to be done before the end of the tax period. So if we have to plan to take the tax grouping benefit for 2025 year, the applications have to be made before 31st of December 2025 itself. So basically for 2025 tax period, we need to identify the conditions if we are fulfilling, and we need to make the applications. Now, if at all for 2025 also, if we have not fulfilled the conditions, in that case, we can try doing the necessary restructurings to be able to take the benefit of tax group, say any kind of subsidiary is not under the parent company and for which we want to avail the tax group at least from the next years. Then in 2025 itself, we should try to complete the restructuring so that right from day one of 2026, we are complying with all the tax grouping conditions. Now we'll be seeing this tax grouping in further detail in the subsequent slides. Similarly, for a family foundation kind of structure where you get the pass-through status for certain kind of passive incomes. In that case, if at all we have to avail that benefit for the periods up to 2025, we need to analyze if the conditions are fulfilled and make necessary compliances, do the necessary filings to avail this benefit. And from 2026 onwards also, if we have to avail, if we do not have the relevant structure in place till now, at least for 2026, we can ensure to have the structure in place, fulfilling the required conditions. Now, there can be various other kind of restructurings as well. For example, converting your sole establishment to an LLC, to a single owner LLC, where the owners may not want to have a personal unlimited liability. They may want to have a legal person under them. They may want to incorporate a company and transfer the sole establishment business to that company, or if they want to convert the partnerships to an LLC, or they want to eliminate the branches and form a company, or eliminate company and get it under the branches, things like this, all these restructurings can be taken care in 2025 so that from 2026 onwards we have the structure in place. Now for qualifying free zone person benefit, in that case also, it is an year-on-year analysis. It is not something that if the conditions are fulfilled in the year one, we get the benefit for all subsequent years. In each year, we have to analyze if the conditions have been fulfilled, if we are continuing to meet those conditions. So we need to analyze that for 2025. And then if we want to avail the free zone person benefit, if any foreign companies want to set up a company, they want to avail these benefits, so they can start incorporating the companies by undertaking the necessary analysis and ensure that the arrangement is in place. Now, as we discussed, transfer pricing is something which is a part of an ongoing compliance. The guidance tells that the transfer pricing documentation has also to be maintained on a contemporaneous basis. That means on a simultaneous basis. It is not something which is a one-time activity. As and when you are undertaking the transactions, you need to ensure that it is on an arm's length basis. So before the close of 2025, at least, if we can undertake the necessary benchmarking exercise and ensure that all the connected person payments, all the payments that we are making to the owners, to directors, are within the arm's length range, and ensuring that we make all the payments within the arm's length price only, so that we get the deduction of that. We need to undertake that before the close of books of 2025. And other kind of related party transactions also, if we have taken any loan from other related parties where we have an interest liability, or we are yet to earn interest income, so all those benchmarking exercises we need to take place. And if we identify that any of the transactions are not on an arm's length basis, then we can do certain accounting adjustments also to ensure that our financials are in line with the arm's length pricing requirements. The next thing is the system and process improvements. In the ongoing compliance section, also, we discussed that we need to have proper bifurcations, proper breakups of the expenses between employee, non-employee entertainment expenses, for example. If there is any kind of VAT expense, then it pertains to what. If any penalties or fines are there, then that can be upfront disclosed in the notes, so that the authorities may not want to go into further investigation in analyzing, okay, what are the miscellaneous expenses, what are the other expenses. If they are able to identify that in the financials itself, that okay, these are the fines, penalties, and if we have properly disallowed in the tax return, they may want to give it a pass. Now, proper disclosures of your related party and connected person transactions, also giving in your financials upfront, may give a certain level of confidence and comfort to the tax authorities that all the disclosures have been provided in the financials, and they may not want any further details. So we can do certain all these kinds of process improvements, improvement in the presentation of our financials or audited financials, so that that kind of reduces, or possibly it may reduce the chance of our case getting into the eyes of the authorities, and they may not want to investigate further. And obviously, we need to have adequate documentation for any kind of transaction that we are undertaking, to be able to substantiate that such transactions had already been undertaken. Now, basically, these are some of the things for the subsequent tax periods that we need to be ready before in hand. Like we saw for 2025, certain benefits are available subject to compliance before the close. In few cases, we need to ensure the arrangement is ready for 2026 years, and all of that needs to be done before the starting of the next year. So basically, we need to always be prepared. Like I mentioned earlier as well, corporate tax compliance is not something which is an year-end compliance, although it may appear to be so, but only the return filing process happens at once towards the year end, 9 months after the end of the tax period. But the preparation, having things in place, proper tax planning, having the structures in place, all of that is a year-round process. Any kind of new undertakings, if you want to expand your businesses or things like that, also you need to continuously have corporate tax implications in mind, and accordingly take your business decisions as well. Now, some of the hot topics under discussion, that we had discussion with many of our clients, we can delve into certain technical topics. Basically, we would be covering the tax grouping and family foundation on an overview basis over here. Qualifying free zone benefit and regarding benchmarking thresholds and requirements to have documentation and all. We have pretty much discussed these topics in our previous webinars, which is also there on the YouTube. So currently we'll discuss the tax group and the family foundation kind of structures. Now, coming to tax group, the tax group is basically an application where the parent and the subsidiaries, if they are eligible, if they fulfill all the conditions, and if they make the necessary applications, all of them together will be combined and considered as a single person in the eyes of the law for corporate tax purpose only. So the federal tax authorities are going to view the entire structure, the entire tax group as a single person, and all the compliance requirements will also be accordingly done only for a single person. Okay. Now, briefly, what are the conditions is that a tax group can be formed only between juridical persons. Juridical person means someone having a separate legal personality from which is different from its owners or its management. So basically, a tax group cannot be formed if a sole establishment is owning a company. Okay, sole establishment is sole proprietorship business is not a juridical person, and therefore it cannot be considered as a parent company. So your parent company as well as all your subsidiaries, all of them have to be juridical person, and a tax group can only be formed between such juridical persons. Single owner LLC may also have a separate legal personality and may be considered as a juridical person and may fulfill this condition. The second condition is it can be formed only between the resident persons. So the company must either be incorporated in UAE or its place of effective management must be in UAE. Further, there should be no conflict with other countries under the applicable DTAA regarding the residential status of such company. Now, share capital ownership. It provides that the parent company must own at least 95% of its subsidiary or its step down subsidiaries. The effective shareholding percentage should be 95%. It can be direct or indirect. Now, this 95 percentage is something which is seen basis the issued nominal issued share capital, and the parent company must be the legal owner of 95% shareholding. If there is any kind of arrangement whereby a person is has been given the beneficial ownership of 95% in a company, such a case may not fulfill this condition. You need to be a legal owner of 95% shareholding. Similarly, 95% voting rights must be there, which is often fulfilled where the share capital ownership condition is fulfilled, unless there are certain other arrangements whereby the voting rights are restricted for certain classes of shares, or there is any other kind of arrangement. Unless any of these is not there, this condition will generally be fulfilled. Now, there is a condition that the parent company must be entitled to 95% of the profits and net assets of the subsidiary. So basically, net asset condition is seen if a subsidiary was to liquidate or was to be wound up today. How much percentage of the net assets of that subsidiary would go to the parent? So this is also generally in line with your shareholding percentage only, unless there exists any kind of arrangement restricting certain kind of rights. Now, the persons in a tax group should not be exempt persons. They should not be taking the qualifying free zone person benefit. This is a very, very important condition that the company can either become a part of the tax group or that company can claim the qualifying free zone person benefit. Both of these cannot go hand in hand. So we have to do a proper cost benefit analysis and identify what exactly would be beneficial for us, not just for the present tax period, but also considering the next 4 to 5 years of tax period, because the moment you leave out the qualifying free zone person benefit, you won't get that benefit for 5 years. So keeping 5 years in our mind, we need to analyze whether the tax grouping would be beneficial, or whether it would be beneficial, to have the qualifying free zone person benefit. Now, all the companies in the tax group should follow the same financial year. Even the newly established companies can form a part of tax group, provided they have the same year end, which is in line with the other taxable persons. So basically, if a company is incorporated somewhere around October, so its first tax period would be October 2024 to December 2025. And other companies in the tax group are also having the financial year end as December 2025. So although for the newly incorporated company, it may be a 15-month period in the first year, but if its financial year end is similar to the other group members, then in that case, this condition would be fulfilled. And all the members of the tax group must follow same accounting standards. The corporate tax law requires all the companies to follow IFRS or IFRS for SMEs. Now, these two conditions are particularly relevant for the purpose of creating aggregated financial statements which are prepared for a tax group. These are special purpose financials which are prepared only for the corporate tax purposes. And for that, the authorities have basically tried to ensure that all the members follow same financial year and same accounting standards so that aggregation of the financials become an easier thing. Now, let us understand with the simple structure over here. Over here, there is a person, a natural person, Mr. A, who is owning company and company B. Now, Mr. A cannot be a part of tax group, or for example, instead of Mr. A, there was a sole proprietorship. Then that also could not form a part of tax group because they are not juridical persons. Okay, so now, company B is also not a part of tax group because company B does not have a parent company, a juridical parent company. Neither does it have any subsidiary for company B itself to become a parent company. So in that case, this is just a standalone kind of company and it cannot become a part of a tax group. It is only a sister concern of company A, but neither a parent or subsidiary. Now, company A is having 100% ownership in company C and 95% ownership in company D. So, company A can be a parent company, and company C and D are directly owned, and the company A directly has at least 95% shareholding in company C and D. So, these two can form a part of tax group. Now, similarly, company D has 100% ownership of company E. In such a case, the indirect ownership of company A in company E continues to be 95%. So it can also form a part of tax group. Whereas in case of company F, the company A is not having an indirect ownership of at least 95% because 95 into 95% would be multiplied and that would result in a figure of around 92 to 93%. So company F also cannot form a part of this tax group. So basically, this is the shareholding structure which will fulfill the conditions which are there. We have assumed that all of these are the resident persons and they are juridical persons and subject to all other conditions being fulfilled. The shareholding condition would be fulfilled only for these four companies, and therefore these four companies can form part of tax group. Now, quickly seeing what is the impact of having a tax group. First, on the registration compliances, it is not that a company can directly become a part of tax group without it itself obtaining its own TRN. So, all the companies, once they are incorporated, they must have their own TRN. And after that, they can make an application to become a part of tax group. And then all these conditions must be met continuously throughout the tax period. If at any time in the middle of the tax period, if any of those conditions are not fulfilled, then that entity cannot continue to be part of tax group. Now, what are the effects of forming a tax group? Like I mentioned, in the eyes of the corporate tax authorities, the entire tax group will be considered as a single taxable person. Only the parent company will file a single tax return. For the single tax return, there would be a 375,000 dirhams exemption limit. All the members of the tax group would be jointly and severally liable. That means the authorities can collect the tax liability or administrative penalties from anyone in whole, unless an application has been made to restrict the liability of any of the members. The losses would get automatically set off. Losses of one person can automatically get set off against the profits of another member because the tax return is filed for aggregated financial statements. Intercompany transactions get eliminated, and then transactions between the tax group members are also not required to be justified on an arm's length basis. So, this is one of the biggest advantages of a tax group. That is, any transaction between the members of the tax group may not be required to be justified on an arm's length basis by performing a benchmarking exercise or any of that sort. Unless there are certain rules of attribution of taxable income in certain cases which kick in. In those cases, the arm's length pricing requirements will still be required. Now, certain other considerations for the purpose of tax group return filing, we have to prepare an aggregated financial statements. Aggregated financial statements means the standalone financials of all the members are aggregated on a line by line basis. So all of the items are just continuously added against each other. All intercompany transactions get eliminated. Your consolidation and business combination kind of relevant IFRSs relating to consolidation and business combination have no role to play over here. There's no goodwill, there's no bargain purchase gain or any of that sort which would be recognized. It is simple line by line aggregation of the standalone financials of different members. And then all of these, the special purpose aggregated financials which is prepared for a tax group has to be mandatorily audited, which was a recent change. There's no threshold of 50 million which would be applicable, but all of the tax groups financials, aggregated financials, have to be audited mandatorily. Now, there's no such requirement that the business or business activities between the members of the tax group should be same or similar. Even if the business activities are not same, still the members can form part of tax group subject to fulfilling those 9 conditions that we just saw. Now, quickly moving on to the family foundation structure. Under the family foundation, basically the need of the family foundation was that the natural persons or individuals generally have investments who generally have investments in real estate properties or in shares, or they have certain kind of personal investments. They are generally exempt in the hands of the natural persons. However, in certain cases the natural persons may not directly own these assets. They may own it through a layer of companies, or they may have established certain entities to own this. Now, in these cases, the companies would get taxed on all such incomes, because in their hands, such kinds of incomes are not exempt. It is only exempt in the hands of natural person. Now, to get the tax transparent status to such entities, there's a family foundation kind of structure which has been provided in the law, which basically tells that a family foundation means basically a foundation or any kind of trust or similar entities which have been incorporated as per the relevant regulations, say DIFC regulation or ADGM regulations, and then which fulfill certain conditions in the UAE corporate tax law. So both of these together, if it is fulfilled, it is family foundation. So there's no such entity type as family foundation. It is just a corporate tax concept which combines a foundation plus the conditions of the UAE corporate tax law. Okay. Now, if these conditions are fulfilled and if application is made to get the tax transparent status, in that case, the family foundation will get the tax transparent status, and then any entity which is wholly owned and controlled by such family foundations will also get the tax transparent status. We'll understand this through a diagram. Now, let us just understand for a family foundation, there are certain conditions to be fulfilled. Now, what are they? The first thing is that the beneficiaries of a family foundation can either be a natural person or a public benefit entity. Natural person must specifically be identified or identifiable basis the charter of the foundation, or it can be a public benefit entity. There's no minimum maximum number of beneficiaries, and there's no restriction on relationship of the beneficiaries also. It's not necessary that they should belong to a same family only. Now, principal activity condition, that means the family foundation is not allowed to do any other activity except just holding or investing in assets or funds from the savings and investments of the members or the members of the family foundation, or the founders who have contributed the assets to the foundation. It can do limited activities. It can disburse certain funds for charitable purpose, or it can incur expenses which help in carrying out the limited activities that it is allowed to conduct. So Just required operational expenses is something that a family foundation can incur. It cannot carry out any kind of business or business activity which requires any kind of license or which has been specified as a commercial business under the commercial business law. So it should not be doing any kind of business activity. It should only be holding the assets and deriving the income. The income can be regular income, it can be rental income, dividend income, or it can be on sale of the real estate property or sale of the investment in shares or whatever other investments which are there. Provided there's no requirement under the regulatory laws to obtain the business license, because in that case the business activity condition would not be fulfilled. Now, the other thing is that such kind of foundations should not have been incorporated only for the purpose of avoidance of tax. So we need to keep GAR implications in mind before we do this. Avoiding avoidance of tax should not be the only intention of creating such kind of structures. And where any of our beneficiaries are public benefit entities, in that case, the income which is being derived should either be exempt income, or the public benefit entity should be a qualifying public benefit entity. If either of these conditions are not fulfilled, there is a stipulation to distribute off the income to these entities within a period of 6 months from the end of the tax period in which the taxable income has been earned. Okay. This condition is generally not very relevant unless a public benefit entity is one of the beneficiaries. Now, let us just understand with the structure. So basically, if a family foundation is there, it needs to fulfill all the five conditions that we have just seen. So basically, this is a normal foundation which has been created, say for example, in DIFC, and then it is fulfilling all the five conditions that we have seen in the preceding slides. Then in that case, after its application to be considered as tax transparent has been approved by the FTA, it will be considered as a tax transparent entity. Now, the benefit that they have also provided over here through subsequent decisions is that if this family foundation 100% owns and controls any other company, and that company also fulfills all the above conditions, that means, for example, company A is completely owned by family foundation. Company A should also not do any kind of business activity. It should only hold the assets for the purpose of earning income, and the tax avoidance condition and all of those conditions have been fulfilled. Then even company A can make an application and get the tax transparent status. So they have provided the benefit to the layers of the companies below the family foundation as well. However, the moment any company in between does not fulfill the conditions of a family foundation, any of the companies below that will not be eligible. So any company in middle, if it does not fulfill, if it is not eligible to be considered as tax transparent, the entire structure below that fails to get the tax transparent status. Now, in this case, if company B, B4, B5, B6 are all fulfilling the conditions, then any income that company B6 derives from, say, for example, investment in shares. For example, it has sold the shares and it has derived personal investment income. Company B6 will have a pass-through status. Company B5 will get a pass-through status. B4 will have a pass-through status. B will have a pass-through status, and foundation will also have a pass-through status. So it will be assumed that all of this income that company B6 has been derived by the natural person beneficiaries of the foundation, and therefore there won't be any tax at any of these levels, and it is tax exempt even in the hands of the natural person. So this is a very big advantage or benefit of such kind of structures, which may help where the individuals are just passively holding certain investments or assets, and they are deriving passive income through those entities. There's no such requirement for any of these juridical persons to have a similar financial year for the purpose of getting the benefit. On an annual basis, all of these entities are just required to file an annual declaration within 9 months from the end of the tax period, confirming to the tax authorities that they continue to meet all the relevant conditions under the tax law to be considered as a tax transparent entity. So basically, in case of family foundation also, if the structure is in place and you want to take the benefit for 2025, the application has to be made before the end of this year. The annual confirmation has to be filed by September 2026. Or if at all we want to take the benefit from 2026 onwards, we need to quickly try to get a structure in place so that we do not lose out on the benefits of family foundation structure. So basically, we come to a close of our session regarding wherein we have covered what all things the businesses should be, at the top of their toes, trying to ensure having adequate documentation so that any kind of request from the authorities does not come as a surprise and we do not fail in complying with the timelines that they provide us to give the information. That also helps us in avoiding any kind of mistakes in our tax returns. That gives confidence for us. That helps in getting confidence in the tax returns that we are filing. We have just seen if any kind of error that we make in we have already made in the tax return, what is the way forward, in which cases we can correct in the subsequent return, in which cases we have to file a voluntary disclosure, and what would be the penalties. And then what are the things that we should be mindful of for the next filing cycles so that we do not lose out on any kind of benefit. We are ready for the next tax period on an ongoing basis, having our structures in place so that at least our subsequent or future tax periods are hassle free and we have the peace of mind. So, like I have been repeatedly mentioning, corporate tax compliance is not something which is just a 2 day compliance thing. It has to be an year on exercise where you always have to be mindful of all these things. Thank you very much, everyone, for joining this. Hope you found this session very insightful, and this would help you, in taking the advantages or the benefits of the exemptions or pass-through statuses or various other kind of benefits that the tax law provides. In case you require us to assist you with anything, these are our contact details. You can always reach out to us and we would be more than happy to help you in complying with the tax laws and in assisting in tax planning. So, if a UAE company is holding 100% shareholding in Hong Kong company, can it be considered as a tax group? Sir, it may not be considered as a tax group because the resident person condition would not get fulfilled in such a case. Tax group can only be formed between resident companies, companies which are incorporated in UAE or having place of effective management in UAE. So unless the Hong Kong company is being completely managed in UAE and it has place of effective management in UAE, it may not be eligible to form a part of tax group. A free zone company and LLC with the same ownership, can it apply for a tax group? So the first thing is that the free zone company should not be claiming the qualifying free zone person benefit. You are offering the income to tax under the normal regime. We are not taking the qualifying free zone person benefit. That would be one. And then the other important thing is that in a tax group, it is mandatory to have a parent company as well as a subsidiary company. So in this case, if both of them are sister concerns, then it may not be possible to form a tax group between these two companies. However, if both of these are being owned by another company which is in UAE, then it can form a tax group. All three companies together can form a tax group. If it is being owned by a natural person, then you may consider, incorporating a company in between so that you get the benefit of this tax group. So, thank you everyone. Thank you for joining. Have a good day.